Bank of Canada is cutting interest rate again. What does it mean for the Canadian mortgage rates? And what type of mortgage should you choose? A fixed or variable mortgage? On July 26, Bank of Canada cut its key interest rate again. It's the second 25 basis point interest rate cut since the start of the rate cut cycle, and the policy rate is currently at 4.5%. The reason why Bank of Canada is cutting the interest rate or taking actions to loosen monetary policy is because of the following factors. Number one, we can see inflation. This is measured in the consumer price index. We came off of 8.1% extremely hot inflation recorded in June 2022 down to currently 2.7%, which is just a little bit above the pre-pandemic 2.2% inflation observed in December of 2019. And on the other hand, we can look at Canadian unemployment rate. The higher the worse, the lower the better. Currently, we're at 6.4% unemployment rate, coming down from the 14% observed in May 2020. But we are actually having a higher unemployment rate today compared to pre-pandemic of December 2019 of 5.6%. And if we look at the GDP per capita growth of year-over-year percentage, we're currently at minus 2.2%, meaning that the GPT per capita has actually shrunk compared to a year ago by 2.2%. But pre-pandemically speaking, if we look at December 2019, we were at 0.8% positive, right? And having a per capita GDP lower than previous year is a bad thing for the economy. And this data went below zero in March of previous year, March of 2023. If you look at this chart, the Canadian GDP per capita has actually declined 5 of the past 6 quarters. It's currently at the level last seen in the year 2017, and the reason for the slower or the decline of the GDP per capita number is attributed to the following points. Number one, we're seeing a slower economic growth due to a higher interest rate. So a lot of smaller businesses, they have trouble borrowing money because of the high cost of borrowing. Number two, we're seeing a population growth outpacing the output growth, meaning that the number of people in Canada grows so fast, it's faster than the GDP grows. That's causing a GDP per capita decrease. But on the other hand, if we look at our counterpart, the United States, they're doing much better on the same data, on the GDP per capita base, because as you can see on this chart, right, they are seeing an increase of GDP per capita, and this is 2020 quick brief recession caused by the pandemic. And this chart shows you the year-over-year GDP per capita data in the US. Currently, they are above zero. They're at 2.6%, much better than Canada, which is negative, which is a decrease of GDP per capita compared to a year ago. And of course, this explains to us why Canada is actually more dovish compared to US, and they're trying harder to cut interest rate. And what does this mean to the Canadian mortgage rate, right? Most Canadians actually experience the high interest rate through mortgage because that's probably one of the largest debt they're going to encounter throughout their life. Of course, besides mortgage rate, they also experience it through various forms of consumer debt, like the car loans, right? And this chart shows you the blue 5-year fixed mortgage rate in Canada and the green 5-year variable mortgage rate in Canada. The data comes from ratehub.ca, right? And as you can see, currently the green 5-year variable interest rate at 5.7% is about 1% higher than the 5-year fixed mortgage rate in Canada, okay? And if we look at the pre-pandemic, which is 2019 December, right, we see that the 5-year variable rate was at 2.5 and 5-year fixed was at 2.29, okay? So we're still a lot higher than the pre-pandemic rate. What we can observe in this chart is that if in the future market is expecting a rate cut, the fixed term mortgage rate is going to be lower than the variable term mortgage rate. That's what's happening right now. the 5-year variable is 1% lower than the 5-year fixed because market is expecting the central bank to cut interest rate in the next couple of years. And when vice versa, when the market expects a rate hike or a rate increase in the future, as you can see observed in 2021 and 2022, what happens is the fixed mortgage rate will be higher than the variable mortgage rate, right? The reason is simple, because the fixed mortgage rate have an element of expectation built into it when they decide the level of the interest rate, okay? And the variable rate, on the other hand, doesn't have that built-in mechanism, okay? So which one should you choose? A fixed interest rate, a mortgage rate, or a variable mortgage rate? It depends on your risk tolerance, because if the variable rate for the 5 years, for the next 5 years, on average, will be lower than the fixed rate you can get today, the variable mortgage rate will save you money, will be more beneficial. On the other hand, if the interest rate doesn't play out as expected by the broader market, what's going to happen is that your variable mortgage rate will ride the central bank policy rate and, of course, the prime rate to go up, okay? Meaning that instead of getting yourself stuck on a fixed rate for the next 5 years, your variable rate will go up, will go higher even, because of the uncontrolled inflation, or because of I'm doing a 180-degree U-turn on a monetary policy. So it's all comes down to your risk appetite. Thank you very much.